Good afternoon, everyone. My name is Andrés Rubio, and I have the privilege of being the Chief Executive Officer of Intrum. I hope you noticed on the way in, we welcomed you in the 38 languages in which we operate every day. On behalf of everyone at Intrum, I'd like to welcome you and give you a true Intrum welcome greeting to this Capital Markets Day. The overarching theme today is going to be Intrum leading the way. We want to show you how we've been able to lead our industry for the last 100 years. We want to show you how what we've built today is a unique and absolute leadership position, but also talk importantly about how we need to continue to develop and how we will continue to lead the industry and deliver for our stakeholders for several decades to come. Just introducing who you're going to hear from today. I will kick it off with a bit of an intro. Also some discussions about where we are today and where we're going tomorrow. I'll be followed by Annette Kumlien, our Chief Operating Officer. Many of you are familiar with Annette. She's a veteran of working with listed and unlisted companies in this part of the world. Then we'll transition over to George Akopoulos, who is the Global Head of Servicing. This is importantly a role that never existed in the history of the company, and it's, I think, indicative of what you'll hear today, which is a focus on building our client service business. Javier Aranguren, our Chief Investment Officer, will talk about our investing business. Michael, who many of you know, our CFO, will come in the end and kind of translate all of these wonderful thoughts, directions, et cetera, into our trajectory and our official targets. And then we're going to wrap it up at the end and open it up to Q&A. But it's not just going to be us. All of you here in Stockholm, all of you watching around the world are also going to be involved today. So we've asked Emily Lundgren to help us coordinate our interactivity this morning. Good morning, Emily.
Good morning or good afternoon.
Or good afternoon, sorry.
Maybe,
good afternoon.
I think. Thank you, Andrés. My name is Emily Lundgren. I'm a director at Fogel & Partners. And yes, I will be the moderator for today. However, I will, as often as I can, fade into the background since you want to hear from the key speakers themselves. And before I get into some practicalities, is this also the order of the agenda we have today?
This is our agenda. It's going to guide the discussions. Again, I'm going to talk about where we are today, where we're going tomorrow. Annette's going to talk about some exciting potential as well as recent activities on the operational front to make us more both effective as well as efficient. George is going to talk about how much momentum we already have and how much potential we have in our client service business. We're going to talk about over the near term how we're reorienting our investing business to extract cash and then long term towards a capital light asset management model. Michael's going to talk about how it all wraps up, and then at the end, I'll just make a few remarks, and you will be able to ask questions of all of us at the end, and also along the way, right, Emily?
Yes. So today is divided into two parts, you can say. Now until roughly 2:30 with Andrés and Annette. Then we have a coffee break of about 30 minutes. And after that, we'll hear from three presenters. At the end, we have an extended Q&A. After each segment, I will reappear to just ask a few questions. And for you in the room, you can, as you see across the room, and as you have also received in the confirmation email from your registration before today, you have a QR code where you can go to that QR code and submit your question via the link, and I will get it, and I will ask them whenever it fits into the program. Or also, for you in the room, if you rather want to raise your hand, that's going to be an option as well at the end of this Capital Markets Day. And for you watching on the live stream, just below the video frame where you see me or us or the slides for that matter, you have just below that you have a questionnaire where you can submit your question as well, and I will take them up as we go along. And I think it's time to get started.
Yes, let's get going. You're going to hear, or see, several videos throughout the day. These videos are critical because they're not just words that we're delivering or graphs or figures on a screen. They're actual human people who talk about what Intrum does and the impact we have. And you'll also see that they're organized all along our main key stakeholders. Initially, this first one is just a general introduction video, which I'm sure you will enjoy.
What does it mean to be responsible? We are Intrum, the market leaders in credit management and portfolio investments. We help clients across Europe get paid so they can focus on what they know best, their business. We believe that the best way to grow is to make a difference. Because our clients trust us with their most important assets, their customers. To promote a sound economy, we also work to increase financial literacy through volunteers, inmate programs, and interactive platforms. Because a sound economy benefits everyone. Informed consumers make well-founded decisions and achieve sustainable private finances. Companies flourish and grow. And our employees are more engaged, knowing that they make a difference. That's being responsible. That's leading the way. That is Intrum.
Wonderful. Again, as I said, I think these videos are really going to show you how we impact not just clients, not just customers, but society as a whole. And I think many of you who follow the company have heard me say this already, in even the short time that I've been CEO, many times. One of the things that I'm most proud of is actually how we not only create a wonderful amount of value for our clients, but just as importantly, if not more importantly, we helped 4.6 million individuals in the last year who have fallen on difficult times, who can't meet their obligations, who've been excluded from financial society, can't get a bank account, can't get a credit card, gain control of their situation, recover, repay, and reintegrate into society. It's a tremendously high impact activity that we do, and it's fundamental to how the financial ecosystem functions. Let's start today's presentation with a simple statement about what we are. What we are is a services company focused on credit management. This is what we've been for over 100 years. This is what we will continue to be for the next 100 years or more. And it's as simple as that. Here, much more specifically, you can see in the top left, we've been doing this for over 100 years in Sweden, over 125 years in Norway. We have a geographic footprint that covers almost 100% of the MPL stock across all of Europe, so we're a truly pan-European platform. As you've already heard me say, we impact 4.6 million people a year by helping them become debt-free. 80,000 clients trust us with their customers. And over our long history, and given the amount of activity we do with customers and consumers, we have accumulated data on over 100 million European consumers. And our platform is not only geographically the largest, it's the largest in terms of human resources as well, with 10,000 people across our 20 markets. Our two key businesses, which we're going to talk about today, servicing and investing. On servicing, we have 250,000. We conduct 250,000 customer interactions every business day. You don't need to do the math. That's over 60 million interactions every year. No one has that scale. No one has that level of touch with the market. And we collect, as you saw in the video, over 90 billion SEK a year on behalf of our clients. So we're incredibly financially relevant to our clients. We're incredibly individually and socially relevant to our customers. On the investing side, we've put 41 billion of our own capital with confidence behind our ability to collect against that and generate more than 2 times, 86 billion of estimated remaining collections. And what that all translates into is the industry's largest revenue base at roughly 25 billion, and by far the largest profit base of EBITDA of approximately 13 billion. One point of clarification for the remainder of the day, for those of you who follow us, you probably know this, but for everyone's benefit, when we say clients, we mean companies for whom we collect. When we say customers, we mean individuals, consumers, who we interact every day with and who we collect from. Also, we think of our servicing business on a holistic basis. So that is not only third-party clients, which are roughly 79 billion of the 92, but also how we service the existing book that exists on the investing side of Intrum. How do we make money? What's our business model? We make money through the value that we add sitting in between clients and customers. We have 80,000 clients, collect over 90 billion. We have over 25 million customers today in the book, and from our clients, who we help repay their debt and financially reintegrate. We do one thing operationally. We have one core operating activity. It is to collect against unpaid claims. We do that across 4 regions in Europe, and we have 2 businesses organized around that activity. Servicing, when we collect on behalf of clients, and investing, where we put our own money and capital behind the ability to collect against a claim. Much more specifically, how do we make money, and particularly in servicing, which is one of the focus areas as we go forward? We start with other assets under management. You're going to hear a little bit later, our AUMs today have hit an all-time high of 2 trillion. We try to collect against that asset under management, and we drive collections. That's our recovery rate. That's the percentage of our total claims or total collectible value that we actually bring in cash every period. Against those collections, which belong to our clients, we get paid a fee. That's our revenue. That's our conversion rate of collections to revenue. We need to deduct our cost of our platform, i.e. our cost to collect, and then we yield EBITDA, which is the total profit, again, that's generated by all the activities in the company and all of the capital employed in the company. Before I get into the heart of my presentation, I think it's important to reflect on where we've come from recently, how we've communicated to the market in the past, and our trajectory against previously communicated targets. Since the last CMD, it is very clear to me that we've certainly become bigger, but we haven't fully benefited from our scale. You're going to hear a lot about that today. We've also not fulfilled the trajectory that we indicated in 2020 on certain key variables. Left to right, investing portfolio, we increased it meaningfully. Our external servicing revenues and cash EBITDA certainly have increased meaningfully over this period, but we did so while increasing not only absolute leverage, but also our leverage ratio. These last 2 variables are the places where we have not fulfilled what we told you previously. We thought we were going to grow our way out of this, as opposed to actively divert cash flow to lower leverage and net debt. And now we're in an environment that could be somewhat understandable in the past because money was practically free, but now we're in an environment where we can't ignore this different trajectory. And as what you'll hear today is lowering net debt, lowering absolute leverage, as well as lowering our leverage ratio is one of our highest priorities over the near term in order to de-risk our financial profile. Where did we go wrong, but what have we built as a result of it? It's not all doom and gloom. We have a wonderful foundation from which we can build upon our leadership position. So we didn't have in the past, in our opinion, sufficient commercial focus and performance management, but we have built Europe's most diversified servicer. We are building the best management team in the country, and it's not just the people you're going to hear from today. It's people 1 and 2 and 3 levels down that we're making significant changes to activate our organization and capture our opportunity. And very importantly, we're creating a supporting collaborative structure that is critical for long-term success. And supporting culture, We had increased costs from what I believe to be a failed technological transformation. You'll hear more about that later. And we had a complex and overly central operating model. Well, today we're moving, and we've already announced this in the last few quarters, we're moving towards a more simplified and balanced operating model, which balances central with local, empowers local teams, enhances accountability at the local markets, lets decisions that are driven locally, that are necessary locally, be done locally, but also certain elements, ops, IT, sales, that are critical, that affect more than one market, are driven by a centralized, specialized capability. And we had an over-reliance on debt-funded investing, but we actually today have probably the best granular credit investing platform in Europe with unique origination and a significant capital base and a cash flow expected on the existing capital invested, all of which can form the basis or the foundation of an asset management business going forward. In addition to formal targets, which we announced this morning, I'm going to touch upon in a few pages, and Michael's going to touch upon at the end, we wanted to give you near-term direction and initiatives, near-term and long-term initiatives and direction that you can use to measure our progress as we continue to communicate to the market in the quarters to come. Over the near term, it's very simple. We want to reduce leverage and de-risk our platform. What are the levers we're pulling to accomplish this? We've already announced this. We're lowering our proprietary investments from typically we invest 6, 7, 8 billion a year. We're lowering it to 2 billion a year. What that means is we're going to be a net extractor of cash from our PI book. The tactical cost reduction program that we announced earlier this year, originally 600 million, we expanded it to 800 million SEK, is well underway, and I expect to exceed that 800 million meaningfully. We've already announced the exiting of 5 markets, and we've announced that we're exploring the exit of additional 3. Those last 3 are purely PI markets where we don't have a servicing franchise. And what they'll do is they'll raise liquidity that we can further add to our organic cash flow to reduce debt. And then we're tactically evaluating a sale of a piece of our back book, which would further raise liquidity and further allow us to accelerate the reduction in absolute leverage and get us sooner to that lower leverage ratio. Long term, you're going to hear about this a lot. We're going to become a tech-driven company, and in fact, I believe that you hear a lot about tech-driven, tech-enabled. I think we need a complete mindset shift, particularly given the nature of our business where we deal with so many clients and so many customers. I think we need to think of ourselves as a services company, not as a services company who uses tech, but as a tech company who does services. I think that shift is an important mindset shift. We've taken some actions in that regard already, both internally as well as externally with the acquisition that we put into our press release this morning. And I think that's going to maximize the potential to leverage technology within our platform. Intense commercial focus. Again, I don't want to preempt George's presentation, but his presentation is chock full of wonderful data on where we've come from, where we're going, and why we're comfortable that we're going to get there. And again, this is the first time ever. This used to be a function that was largely distributed to the local markets. We believe that a centralized focus on our commercial development is a critical value add and gives another tool for the local management teams to develop their business. On the PI side, we're going to leverage third-party capital. You've heard from me already in the last few quarters about a capital partnership. You've heard from me also about our ultimate goal of creating a broad-based credit asset manager. That is still our plan. In the months to come, as that takes form, we're going to come back to you and explain more about what exact form it's going to take and what impact it has. And then we're doing all of this with a very simplified and balanced operating model, which I'll comment later. But our goal long term is to grow profit and create the leading servicer and asset manager. It's important to note that this is not something we just created for the Capital Markets Day because we have to give you a new direction. This is something we've already been doing for the better part of the last year since I became CEO. We're simplifying our business. We have 2 businesses, servicing, run by George, and investing, run by Javier. It's as simple as that. Operationally, we're already changing our business model, our operating model. We have reestablished a performance culture across the markets that's consistent, that can look at drivers, that can look at the performing markets and the less performing markets. Why are they performing differently? So that we can create a continuous improvement culture based on performance. We have done acquisitions, and it's important to note that our acquisitions, we will continue to see acquisition opportunities. We're the biggest player by far in a sector that inevitably will have strategic activity and may even go into a wave of consolidation. As the market leader, we're going to be the first phone call every time. But it's very important to be disciplined, and we've looked at the 2 acquisitions we completed this year through a very particular lens. Any strategic or inorganic growth opportunity has to fulfill 2 criteria fundamentally, and then others that are more specific to the situation. But fundamentally, they have to add to our client franchise, such as Aya did, bringing on Caixa and BBVA, adding to Sabadell and Santander in Spain, basically giving us the entire big bank market in Spain. And Arrow, which took us from not a leadership position, somewhere between 5 and 10, to number 2 basically in that market, gave us 2 very important servicing platforms, as well as a large asset base. So it made us a leader in one of the biggest economies in Europe. The second criteria is that it has to be consistent with our long-term deleveraging strategy. It cannot veer off of that. Our view is that we're going to delever over the near term, so any acquisition has to fit within that requirement. And then we've already started going to capital light. We've already started to focus our business model, agreeing to exit the Baltics, Brazil, and Romania. You've heard me say this. Those businesses were about 1% of our assets, and we're about 0.2, 0.3% of our EBIT. So that wasn't about raising liquidity or anything. That was about focusing resources. And then we've announced the potential exit that we're exploring of the Czech Republic, Hungary, and Slovakia. Those markets are are investing markets. They're several hundred million euros. And those would add meaningfully to our liquidity that we could then use, in addition to our organic cash flow, to reduce leverage. Okay, this is one of the most important pages that we're going to present today, and I'm sure it's going to be very topical for everyone because it says basically how these near-term tactical measures, also the beginnings of our fundamental long-term transformation of the business, translate into financial performance and how we're going to delever. So here, 2024 and 25, we will produce approximately 25 billion SEK of cash EBITDA. We have already reduced, as I said, our annual investing budget from 7, 8 down to 2 a year. So over the next 2 years, we'll invest roughly 4. You deduct that. We have to obviously pay our cash taxes, our cash interest, and that gets us to 12 billion SEK of discretionary cash flow. This is a figure that we often say, but I don't think is fully appreciated by the market, and maybe it's the way we present it, maybe the market doesn't fully understand it, but this discretionary cash flow, we have always said in the past, can be deployed at our discretion 4 ways. We could buy assets, we could do M&A, we could reduce leverage, we could pay dividends. Between now and the end of 25, we are going to dedicate all our discretionary cash flow to reducing leverage, to de-risking our profile. To this discretionary cash flow, you need to add the potential backbook sale, as well as the 3 country exits that we referred that are in process, that are going to produce, in my opinion, at least 6 billion, and our cash on hand. That gives us total cash that we can divert to debt reduction of 20 billion SEK over this time period. What are our debt maturities through year-end 2025? 20 billion SEK. What this means is that we can fulfill our obligations without relying on the market. We will probably be in the market to maintain access as well as flexibility. We don't have to be in the market. Even if the market completely shut down, we could fulfill all of our obligations through the end of 2025. A key part of de-risking over the near term. What does this mean in terms of financial trajectory? We're going to reduce our investing portfolio by virtue of that reduction and extract cash from our portfolio. We're going to grow our external servicing revenues from about a little bit under 11 to 15. We're going to increase the profitability. George is going to talk a lot about how we're going to accomplish that. And consequently, we're going to drop our net debt or absolute leverage level down 30%, and we're going to come down to a leverage ratio of 3.5 by the end of 25 and lower than that in 26. This potential, which again, Michael's going to go into more detail, has certain elements that we have not included that represent significant upside. So some are just conservative assumptions. Financing cost. We have assumed that the financing cost in anything during this period remains at the current elevated level. That means we have not assumed a normalization of the market. We also have not assumed that even if we delever, that our own cost of capital comes down. We've assumed that when we exit a country or exit backbook assets that we don't retain the servicing. That's not going to happen. I believe that will not be the case. I believe anyone we transact either in those countries or in the backbook will want us to continue to service those assets. But it is a prudent and conservative assumption. Asset management, what I talked about, a capital partnership over the near term, a true asset management over the medium to long term is not in these numbers. And again, as I said earlier, as that takes form, we're going to come back to the market, explain it to you, but it is not in these numbers, and it will be additive to these numbers. And then tech acceleration. We have a tech path. We announced this morning that we've agreed to acquire, pending FCA approval, Ophelos, which is the only purely digital, autonomous debt collection platform in our industry. What that's going to do for us is accelerate our journey to do more things like digital interaction, self-service interaction, make us more efficient, lower our collection cost, while simultaneously increasing our effectiveness, increasing our collections. None of this is in here, although the acquisition cost of Ophelos is, but the benefit is not. Okay, fundamentally, we've organized ourselves today, and we think of ourselves this way, which is our operations and our two businesses. Today, you're going to hear about operational excellence, where we want to be more tech-driven. We want to be more of a technology company. That can only lead to, as I said, improved efficiency and improved effectiveness. Improve our client value proposition, which leads us to then get more clients and do more with them. We want to do more with more clients at a higher profit. If we improve our product, which is fundamentally operational, we can sell better and we can make more money over time on it. And finally, over the near term, we're going to extract value from the significant ERCs that we have, 86 billion. But over time, we're going to use that significant capital base to be the anchor of a capital-light asset management strategy. Formal targets, we announced them this morning. They're corresponding to the page we did a couple of pages, or the figures of a couple of pages earlier. That 10.6 to 15 roughly is about 10% CAGR in our servicing growth. Our EBIT margin will be above 25%. That's total adjusted servicing margin. Michael will explain what that is. We are going to reduce our balance sheet intensity, which means we're going to reduce our book value to approximately 30 billion, plus or minus. Our leverage level will be at 3.5 by the end of 25, and it'll be lower in 26. And it is our intention to resume rewarding our shareholders for owning our stock in the form of a dividend as soon as we achieve that 3.5. Where are we today? What have we built? How do we stack up? We've always been a leader. I said this earlier. For over 100 years. Far left, Oslo, Norway, 1933, one of our operation centers. Kind of looks like some of our offices today, except it's in black and white. 1960s, we started using phone calls as a collections mechanism. That's in Stockholm, Sweden, in 1964. And today, we have 4,000 people who have 22 million phone conversations a year, who manage those 130 million plus customer activities, collections activities, of which 500 are in this one call center in Valladolid, Spain. So clearly we've evolved. Also during this time frame, as I said earlier, we have had the privilege of interacting with over 100 million consumers. We have data on over 100 million consumers. And thankfully, unlike the 1960s in Stockholm when they were in paper files, today they're in electronic form, which means we can use them readily with the application of technology to not only improve our collections, but also create new products for our clients and new revenue opportunities for ourselves. Again, sales and margin. What have we built? We have built the largest, the most diversified business in the industry. We deal with a cross-section of clients, banks, financial investors, industrials. We do so across all of Europe. We have a full spectrum from performing to non-performing to assets to consumer to secured of asset classes, and we have a full range of services that George is going to go into much more detail on later. But how does that stack up against our competitors? This page is also one of the most important pages. They're all important, but this one's particularly important, I think. It is very simple. If you want to invest in the credit management solution space, there is only one choice, and it's Intrum. What is this page? The vertical axis is servicing revenues as a proxy for the size and the importance and the relevance of your client service business. The horizontal axis is your ERC 120 month as a proxy for how large and relevant your investing business is. And then the size of the circles indicates how many markets you operate in. The larger the circle, the more markets you operate in. What does this page clearly show? That when you look at the pure play servicers, you have two right there. We are 2 times the size of doValue. We're 5 times the size of Prelios. doValue operates in 4 or 5 countries. Prelios operates in 1 country. Prelios also operates in pre-collections, an indicator of where the market's going. Prelios traded a few weeks ago for over $1.3 billion, and that's almost 10 times EBITDA, telling you how valuable that access is, how valuable that business is. We're bigger than both of them, and we're in more markets, and we're more profitable. When you look at other people who I'm still somewhat surprised that people view as our competitors across the bottom, you can see that they're not very meaningfully in servicing, because they're really only in servicing to the extent they have their own book, but they are essentially just investors, where they take capital from one person and invest it and they make a spread. That's capital. But even there, we're bigger than all of them, comparable to Encore, but they're a US entity, does something different, but we're still bigger than all of them. I think what you see here is that we have an absolute leadership position that we can continue to build upon, and we're the only person who brings that integrated model, bringing both sides of the equation to bear for our shareholders. More specifically across our Northern Europe, Middle Europe, and Southern Europe franchise regions. And these are 16 markets, plus Poland, who I would classify as our 17 franchise markets. In each one, we're the top player or in the top 3. All of them are very sizable, in particular in Middle Europe. You're going to hear about that later. We have clients across all 3 geographies, and we have some clients who follow us in all 3. So we have Santander in all of them, but in every one we have unique clients and specific clients. And we also have broad-based and more region-specific competition. And again, some of these competition are capital. They're not necessarily servicers. But we have competition everywhere. We don't lack competition. We actually win on a regular basis, which we'll get into later. This page is important because my belief is that the most critical variable to determine revenue growth and profit in servicing is market leadership, which is why you've heard me say several times since I took over that I want to be number 1 in servicing, number 1 in investing in all our franchise markets. This is critical. The environment we're in, this is important. I can say without a doubt that our clients are going to need our services more in the next 5 years than they have in the last 5 years. Why? Because the environment is driving towards consumer distress, so to speak. Far left, inflation, no one here, that's not a surprise to anyone, has exploded from under 2 to 7%. Household cost of borrowing has gone from under 2 to above 3.6, more than 2 times since 2019. This is an effect that hasn't been fully felt throughout Europe yet, and it's going to create ripples and impact for several years to come and across all of Europe. Wages have been flat, which means the consumer is basically going backwards in terms of purchasing power. And then bankruptcies, just to give you an SME or corporate proxy for the amount of distress in the system, are accelerating, and they're at the all-time high since 2015, the year those kind of statistics began to be recorded. Why is this important? Because most of our large clients are banks or financial institutions. And you can see here when a claim or a loan goes from performing to underperforming, and in particular when it goes to impaired, there's a significant ramp up in capital cost in terms of provisioning for our clients. Why is it important now? Because as you can see here, since 2019, stage 2 loans have doubled. The percentage of the total stock of loans in Europe has gone from under 7 to almost 10. This is incredibly relevant. We deal with human lives. You're going to hear about that a lot today. We also deal with incredibly valuable factors for our clients. This is also translating into our own numbers. We will see long-term all of these factors translate into AUM, servicing revenue, and with a lag, investment opportunities. But just in the last year alone, you see that our AUM, as I mentioned earlier, recently hit an all-time high of 2 trillion SEK, has grown 9%. And in the last year, not surprisingly, our external servicing revenues, as our clients need our help more, has grown almost correspondingly at an 8% rate. But also anecdotally, when we talk to our clients, 1 in 2 expect late payments to increase, 1 in 3 expect defaults, NPLs, to increase. Anecdotally, statistically, economically, it's all moving towards more assets for us to manage and us being more important to our clients, and with a lag, an opportunity to invest in those assets. Another factor that is often thought of as a headwind, but I believe it to be a tailwind for us, is regulatory. Our industry touches financial institutions and consumers, therefore is continually under regulatory scrutiny and pressure. But as the market leader, we're in constant dialogue with the regulators. We drive industry standards. We've been working with Brussels for the last few years on the new NPL directive. We try to stay ahead of regulatory trends. Why is this important? Because when a client trusts us to collect against their claims, they're trusting us with their customers. They're trusting us that we're going to do things in the right way. They're trusting us that they are dealing with the best platform, the platform that most knows the regulatory framework, that won't run afoul of the regulatory framework. We have an investment over our history across all of our markets. We give clients the greatest level of comfort. And this is something that is actually a tailwind, because none of our competitors have the ability to replicate this, in my opinion. All right, now it's time to talk a little bit about our role in the financial ecosystem. And I'd love to start with a video which talks about or shows you the motivation of our employees.
When I first started, I thought it would just be phoning up people and being like, you owe money, you need to pay it. But it's completely different.
90% of the people who calls us wants our help.
I think working with debt collection is a way of helping others to get back on track.
I do feel like we can actually help a lot of people here.
It's obviously difficult situations, and the conversations are not always easy.
It's about that individual. It's about, let us help you, let us understand it. Forget about your money problems. Let's just bring it down to normality. It's not easy to be brave to be able to speak on that type of level.
You need to listen to the customers that's calling you, because they're people. We are people. We're not a robot or anything.
A lot of the time when you come off a call, you know that you've helped that person, particularly if they're going through a difficult time.
We make a massive difference in people's lives as far as I'm concerned. I've made a difference. Like, I'm not going to be a nurse or a doctor or a brain surgeon or what have you, but at least at this I can do something good for people.
I love these videos. I'm not going to be a nurse. I'm not a doctor, but I think leading this company is one of the things that I can most do with my life to impact people. And you see that, you saw that in that video, and you'll see that throughout the day. At Intrum, sustainability cuts across everything we do. And we look at it as to how do we deliver for our key stakeholders. Top left, we deal in something that's very important to our clients, and we have a high level of client satisfaction. Top right, you've already heard about this a few times, but we help people who are in a difficult situation get through that and reintegrate into financial society. That client impact, that customer benefit, leads to an incredibly high engagement index. I don't even need to talk about this. You saw that video. You saw the faces. You saw the words. Every time do I go to a call center, I'm blown away by the energy that exists in these centers. And it exists because of that feeling that you saw in that video. And the bottom left, we're not an industrial company, but we do need to think about the direct impact we have on the environment. And within the context of our business model, we do everything to improve on that front. In addition to the formal financial targets we announced this morning and I showed earlier, we have specific ESG targets across the board with regard to customers, clients, employees, society. And we always strive to do better. But where we are today even is already highly rated by a broad panel of third-party experts. So with regard to ESG, we're more S than E or G, and we're high impact. That's important. Okay, now I want to give you a little bit of a summary from my perspective and a bit of a sneak peek as to what you're going to hear from Annette, George, and Javier. Operational excellence, tech-driven operations. How do we get better? It starts and ends with how we work together, how we collaborate, what talents mesh together, the people we have, the seats we put them in. We are going and reversing One Intrum, in my opinion. One Intrum was necessary at the time that we implemented it, because having 20 different countries do 20 different things makes no sense. But at the same time, having one central direction and operation of a company does not make sense. So we're going to a more simplified and a more balanced operating model. What that does is it empowers markets, who previously had to listen to the center to see what they would do. Creates ownership, ensures clear P&L accountability, We want the local markets to drive decisions and profitability because they're closest to the clients and closest to the customers. We want to give them the tools, the knowledge, the support to be successful. You're going to hear about performance management. You're going to hear about technology. You're going to hear about lots of commercial focus. You're going to hear about putting capital behind our activities. All that supports the local market heads in being more effective in their business, and that'll translate to the bottom line. We're going to reduce complexity and simplify the organization by creating more collaboration and more clarity and more transparency. And we're going to improve effectiveness, and we're going to achieve cost savings, which we already are, particularly in the center, but also in the local. By supporting them, by making them more effective, we also make the local markets more efficient. We certainly are going to reduce our central costs. Okay, let's talk about our digital journey or tech roadmap. While I said earlier, and it always sounds wonderful, we're the leader, we've evolved, etc., we still have a lot more to go. There is no doubt about it that we have a lot more to go. Today, 4,000 out of our 6,000 employees in operations under Annette still just make phone calls. They spend time making phone calls. Remember, we started making phone calls in the 1960s. Have we really evolved? And that's going to talk a little bit about that. But what we can do there? We can automate. We can make it actually more efficient, more automatic, or more automated, but make it also a better experience for our customers. That's the challenge, but that's also an opportunity. We have 60% of our agents spend 60% of their time, dealing with emails and SMSs, things that are not digital. They are digital relative to 20 years ago, but they're not truly digital. They're normal means of communications now. That is not digital. What really is digital is what's at the bottom. How can we engage with a customer who can get onto a portal, can figure out what is this related to? It's related to this debt. Okay, I can only pay this much. I have to pay it back. Get into a payment plan and actually then get a solution. Portal visits, less than 1% of our actions. We have 130 plus million actions a year. Less than 1% are digital, portal, interactive, self-serve. We have 80,000 clients. We have some big clients, which George is going to focus a lot on, but we have a lot of small clients. We need to work for both of them. We need to make sure that our model is profitable with both. This is a big driver of efficiency and effectiveness. How does this translate into numbers? 130 plus million activities, 4,000 agents handling 22 million actual calls. We dial a lot more calls, but we make 22 million phone conversations, 40 million emails. Well, 60% of the time that an agent is in the call center during their working hours, they're productive. The other 40%, they're not directly productive. We can improve upon that. More than half of their productive time is spent on simple emails and simple calls, things we can easily automate. In fact, we can probably automate it and enhance the customer experience. When you translate that into numbers, and these are indicative top-down examples, all else being equal, if we increase self-serve to 20 or 25%, which in today's day and age is absolutely achievable, we could improve our annual EBITDA by 400 million. All other things being equal, no increased volumes, no increased clients, just on our current base. If we amplify efficiency and effectiveness, in other words, we become a little bit more efficient, lower cost to collect, we become a little bit more better at driving collections, there's another 700 million. These are illustrative examples, but what they show you is we have potential benefits of scale, going back to that early page, that we haven't benefited from despite our size. But thankfully, given our size, these are things that if we focus on, we can achieve. Okay, client focus. You're going to hear lots of figures from George. He does a great job presenting this, and I'm delighted with the progress we've made in commercial effectiveness since I took over, but more particularly since it's accelerated since he took over his position. But I'm going to bring it back to one small anecdote. I was in June at a CEO meeting in Spain. In fact, this is with the CEO of Bank Sabadell, one of the top 3 or 4 banks. And I was with José Luis Bellosta, who's right here, our head of Spain. And very early in the meeting, he turned to us and said, we view Intrum as our partner in managing and lowering our cost of risk. That's an incredibly powerful statement. Think about that. And the 2 words that I really focus on are partner and cost of risk. What does partner mean? Partner doesn't mean you're a mere service provider, that you're going to be negotiated with continually or put into competition. No, they look at us as a partner in finding solutions for really complicated problems. That, over long term, means you're going to do more things with that client, you're going to deliver greater value, and if you improve your value proposition, you'll make more money. Cost of risk. Cost of risk is something which is very financial. Most of our large clients are financial entities, and it's a massive, massive variable in their results. It's of significant financial importance to them. And they trust us as their partner in dealing with that. Again, translate this concept to figures. Here you see cost of risk across the top and operational efficiency across the bottom. The two impacts that we have when we work with someone to outsource their collections activities. Top 25 European banks, who by the way, 23 are Intrum clients. Total loans, 11.8 trillion. Provisions at 35 basis points cost of risk, about 41 billion. Just reduce that 35 bips. By 1 bip, you generate 1.2 billion across the system every year. We have real life case studies that we work with large clients to see what our impact is. Well, we've seen on sizable client relationships that we can improve their non-performing exposure performance by 10 to 15%. The other benefit, which I don't think always everyone appreciates, is that when we provide collection services, they're outsourcing an important industrial activity to these clients. And here you see 55% cost income ratio across those same top 25 European banks, 275 billion cost base. Just lower that by 10 basis points, you get $500 million of every year benefit. Well, we have specific real life case studies where we can reduce your IT costs by more than 50%. Our annual third-party servicing revenues are a bit above 10 billion SEK. Call it give or take a little bit under €1 billion. We can deliver many multiples of value on that, of that. Many multiples of that in terms of value to our clients. Finally, Javier and our investing business and our rotation to capital light. Over the near term, we're going to extract value. Over long term, we're going to pivot to a capital light partnership and then ultimately a broad-based credit asset manager. Why are we doing that? Because what we have today is unique. We have a proprietary origination capability where last year we invested 7 billion SEK across more than 250 deals. And where more than half the assets we bought, we had touched at some point as a servicer. That's proprietary origination that no one else has access to, that just comes in off the platform. That's incredibly valuable. If any of you are investors, private investors, you know how valuable having access to that flow is. We have an underwriting track record, which over 18 years, and it's my favorite graph we show it every quarter, over 18 years, we've grown our investing business by 17 times. Yet during that 18-year period, we have a track record of collecting 106% of what we originally forecasted when we bought the assets, even though we've grown 17 times. What that says is we're prudent in our underwriting, and the industrial expertise, which is the third element here, we get better at collecting every time. And our investing business and future, our investing partners will benefit from that. You add this together, which is unparalleled, to third-party capital, you get the potential for an incredible, sizable, value-add, differentiated asset manager. Why do we do this from numbers perspective? Why? Because it improves our profitability and our scalability. Profitability, unit economics. Today, in our model where we invest 1 unit of our own capital, 1 unit of leverage, it equals 1 unit of return. So the 100 becomes 150. We get a servicing markup, which is our servicing profit on our own assets, because we price these things on an arm's length basis. We make good money, 57% ROI, 1.6 money multiple. But what if we transition to something where we're investing 30%? Someone else is investing 70. We make the same 1.5 on our investment. We make the same servicing margin because it's the same perimeter of assets. It's 100 units in one, 100 units in the other. But we also make origination fees. We make asset management fees. We make performance fees, all of which doesn't consume capital. What happens? We make a meaningful amount of more money. Not only this, but also by leveraging third-party capital, we don't hit the ceiling or the constraints that we have in funding everything with our own balance sheet. So we can scale up. So not only are we going to scale up in volumes and really invest more, but we're also going to make more money. What that means is the quality of earnings. And this is what I said earlier, that those people on the horizontal axis, they're capital. Are they differentiated? Do they have our proprietary origination? Can they do what we're talking about here? What we're going to deliver as a result of this is there's still a capital-based return, but there's a business return on top of it. It's going to be higher quality earnings and greater earnings over time. With that, I think I'm done, and I think you want to ask me some questions, Emily.
I want to ask you questions because they're coming in from you as well, either on the live stream or via the QR code. But I just have to ask you, Andrés, I find it interesting what you've begun talking about, the simplification of your business model. Because in my experience, analysts, fund managers, investors have said you're too complicated to understand. Are you kind of giving them a little bit of right here? You were very complicated? Or do you find that Intrum was rather misunderstood?
I think it's a combination of both. I don't think we did ourselves any favor by the way we presented our business in the past and our focus on portfolio investments. Because when you translate portfolio investments into accounting, it confuses the picture. We're emphasizing services. There's no such distinction on the servicing side. And on asset management, it's going to be more clear. Also, what we're going to be doing, we've also simplified our business. We don't have strategic markets. We don't have CMS. And what you're going to see as of later this year in our new disclosure is there's going to be an investing P&L, there's going to be a servicing P&L, there's going to be central items, and then there's consolidated. And you can literally add across. We're also going to give some data across regions. I think that's going to infinitely make it easier for people to understand our business, for people to project our business, also to very quickly look at what are the drivers, where are we making money, where are we growing, where are we highest profit, and why. I think we can do a lot better, and we're moving towards it.
I also want to backtrack to what you talked about, the new financial targets and the dividend. And just to make it clear then, you're pausing dividend until you deliver on your debt level of 3.5 or less. So no dividend until 2026?
Okay, we are pausing our dividend until we reach what the market thinks and what we think is a more sustainable level of leverage, which is 3.5. We're going to reach that by the end of 25, and then we will go back to rewarding our shareholders.
And some questions are coming in as well. Speaking of that, you said simplification, you're looking to exit some markets, you have decided to exit some markets. Camille wonders, could you explain the logic behind having Poland as the only tactical market?
Well, it's interesting. Poland, it's a very good question, and I get this question often. Poland, unlike the other three markets, does have a somewhat, I would call it burgeoning servicing market. There's lots of projections out there that Poland market, the economy is going to be bigger than the UK in 10 years. It's a fantastic economy, I think. I think it's one that has significant potential for servicing, and therefore we've decided not to explore exiting it at this time.
And we have, now they're pouring in the questions just because of that, so I'm going to find wherever I'm at. Johan wonders, the target below 3.5 times your leverage ratio. What is the right leverage level long term for your type of business?
It's a great question, and I think most of the markets heard me say, I don't think we have an issue with leverage necessarily. In this world where our leverage cost is much higher and we have large maturities, it's prudent to delever, but I'm comfortable with 3.5. I think when you look at our ERC and just run it off, we could pay off all our debt. We're the only person in the entire industry who can do that. That doesn't even count the fact that we make $2+ billion in EBIT from our servicing every year, going to 4, which you'll see later on. So I'm comfortable with our risk profile relative to our debt, but regardless, we're still going to delever over the near term because I think that's prudent given the environment.
Jacob wants to know, how do you expect the EBIT margin to increase from roughly 18% to 25%? How quickly should we expect?
So again, these targets are from now till 26. You'll see it later very clearly in George's materials across new products, across new regions, but it fundamentally is focus and growing and becoming that. Remember that market leadership point I made? That is important. If we grow and become the market leader, we will have the highest margins. We're very comfortable. We've already seen recently an improvement in our margin trajectory, and I'm very comfortable we're going to get 25 or higher, but it will be in much more detail in George's section.
And this might be a bit technical. Patrick wants to know, you mentioned you might tactically sell backbook. Historically, that has been out of question given IRR levels versus financial cost. What has changed your thinking?
Simple. We want to have, and it may be in conjunction with a long-term capital partner that we do a piece of the backbook. It may be just a backbook deal. We're still evaluating both alternatives. But I think it's important in this moment, we're going to transact at or about book value. So that validates our book value. It also raises further liquidity, and we can use that cash to reduce debt. Our cost of debt in the secondary market, as you can see, is in the 12, 13, 14 range. Our ERC after operating costs relative to our invested book value over time produces a 14% return. So that equation has gotten a lot narrower. I think it's prudent for us to think about a tactical back book sale to further add to our ability to delever over the near term.
And Jacob wants to know, the 6 billion you point to from back book and exits, could you give the split or the
I
relative-
cannot.
You
I cannot,
Oh.
unfortunately. I think it's very meaningful. What I said is the 3 markets are several hundred. You can interpret what several means. And also, I think we'll get at least to 6 billion. So that gives you an idea that we're not talking about a small back book deal. We're talking about a meaningful back book deal. I suspect or expect to probably exceed that 6 billion figure.
And Wyatt wants to know, how are costs allocated across business segments?
So local common costs are allocated, central costs are allocated according to revenues, local costs are allocated mostly to the servicer. Michael can answer that question later in more detail than me.
Angelica wants to know, will you pay the final dividend of about 6.75 Swedish kronor, which was already announced last year?
Absolutely, yes.
Let me see. I kind of want to touch upon the dividend again for you while
please.
I kind of go through your questions. We have a few more questions before we let Annette up on stage as well. Given that it was basically an Intrum identity to be a high yield stock, was it hard to pause the dividend?
It was not an easy decision. Intrum has paid dividends for as long as they've been listed. We had long discussions at the management team. Obviously, it's not a management discussion, or decision, I should say. It's not even a board decision. It's recommended, and ultimately our shareholders agree. We have some very large shareholders who are on our board are also big beneficiaries. But everyone realized that the world's changed. I have challenges sitting in my seat that my predecessors didn't have, and you have to act accordingly. And the de-risking emphasis over the near term, while still building the business, everyone in the management team, everyone at the board, and hopefully most of our shareholders completely agree with that. And that meant that for a period of time, we needed to pause the dividend. And in the end, it wasn't controversial.
I'll let you off the hook for now, Andrés, because we
Thank
need
you.
to get moving. But I'm very grateful that you all are very active, because the questions are really flowing in. So we hope that that is going to be able to be covered later as well.